Okay, let's talk about one of the biggest, most important financial decisions you might ever make. We're talking about picking just one single investment and holding it for the rest of your life. And the hardest part isn't even making the choice. It's fighting that constant urge to jump ship for the next big thing. It's having the discipline, the sheer conviction to stay the course for decades. So how in the world do we build that kind of lifelong conviction? Well, we're going to follow this 6-step blueprint. First, we'll really frame what this commitment means. Then we'll define some super strict rules for picking a fund. We'll check out the top contenders, and then, and this is really important, I'm going to share a crucial warning that could honestly save you from a massive, costly mistake. All right, first things first, let's get our heads in the right space. This is not about finding some hot stock that's going to pop next quarter. Nope. This is about choosing a financial partner for the next 30, 40, maybe even 50 years. The stakes, they're incredibly high. The source material had this absolutely brilliant analogy. It says choosing an ETF is a lot like choosing a spouse. It's a long-term commitment, right? There are going to be good years, there are going to be bad years. But the goal is to stick with it because a divorce, selling your shares and having to pay taxes on the gains, that can be unbelievably expensive. So what are we looking for in this ideal partner? It's actually pretty simple. They need to be globally diversified, cheap to maintain, big and stable enough that they'll be around, and maybe most important of all, they have to do exactly what they say they're going to do. These are our non-negotiables. Okay, now let's get a little more technical and actually build the foundation for our decision. We need a really clear, objective set of rules, kind of like the architectural specs for our perfect fund. Here they are, our 6 hard rules. Number 1, fees have to be low, period. 2, it's got to track its index like a hawk. 3, it needs to be big, over 500 million in assets, so we don't have to worry about it suddenly closing down. 4, it must be physical, meaning it actually owns the stocks, no funny business with complex derivatives. 5, no currency hedging. That just adds costs and complexity we don't need. And finally, number 6, it has to be accumulating, which means it automatically reinvests all the dividends. That's how we really get that compounding magic to work for us. So, with our rules in hand, let's start the search. And we'll begin with the classic core of so many portfolios, ETFs that focus only on the developed world. Now, these funds, they invest in the world's most established economies. But here's something you really have to be aware of. Because the US market is so massive, your exposure to it is going to be huge. We're talking somewhere around 70%. That is a pretty significant concentration in just one country. So when you look at the options here, you've got 3 main players. There's the classic MSCI World Index, kind of the industry standard. Then you have Solitact, which often lets providers offer lower fees. And then there's the FTSE Developed Index, which is a little broader, mostly because it includes South Korea. So each one has a slightly different flavor. But wait a minute, what if we want the whole world, not just the developed part? I mean, to really get the full picture, we've got to expand our search to include emerging markets. These are the ETFs that add countries like China, India, Brazil, and Taiwan to the mix. And yeah, right now they only make up about 10% of the fund's total value. But these are some of the fastest growing economies on the planet. They could easily become the market leaders of tomorrow. Okay, so let's break down these global options. The MSCI ACWI is kind of your baseline. Covers about 85% of the global market. The FTSE All World takes it up a notch to 90% and throws in some smaller companies. But if you're the kind of person who wants to own everything, then the MSCI ACWI IMI is an absolute monster. It captures a staggering 99% of the entire global stock market, the whole shebang. Phew, okay, we've surveyed the landscape, we've analyzed the options. It is time. Time to draw up that final blueprint and actually make a choice based on everything we've just learned. After you filter everything through our strict criteria, it really comes down to these 2 giants. You've got the SPDR fund, which tracks the MSCI ACWI, and it often has a teeny tiny edge on fees. And then you've got the Invesco fund, which tracks the FTSE All World, giving you slightly broader coverage. Honestly, both are absolutely fantastic choices. But hang on, I can almost hear some of you yelling at the screen right now. What about Amundi? Look at their fees. They're less than half of the others. I mean, yeah, looking at this chart, they seem like the slam dunk obvious winner, right? Well, this brings us to a super important question. Is the absolute lowest fee always the best choice? Or does that rock bottom price tag maybe come with a hidden cost? And here's the catch. The source we're looking at flags a few concerns with Amundi. For one, they have a history of merging funds. But more importantly, they've been known to actively exclude certain stocks from their index funds. Now, this introduces an element of active management, of provider interference, into what is supposed to be a 100% passive investment. And this quote from the source just nails the purists' passive investing philosophy. The whole goal is just to own the market, all of it, the good, the bad, the ugly, without a fund manager stepping in and making subjective calls on what to include or exclude based on ever-changing opinions. Okay, we're almost at the finish line, but I've got to tell you this last point is arguably the most important one of all, especially if you already own a world ETF, and now you're thinking, maybe I should switch. The takeaway here is as simple and as absolute as it gets. Do not sell your existing funds just to switch to a slightly better one. This is, hands down, one of the biggest and most common mistakes an investor can make. So why is it such a bad idea? It comes down to one word: taxes. See, if your current investments have made a profit, selling them triggers a capital gains tax event. And that one-time tax bill will almost certainly cost you way, way more than you'd ever save from a tiny difference in fees over many years. So what's the smart play? It's simple. You keep your old shares. Just let them be, let them keep growing. But from this point forward, you direct all of your new investment money into the new ETF that you've chosen. This way, you get the best of both worlds without that brutal, costly tax hit. And that brings us to the final question, the one for you to answer. After looking at all the evidence, the criteria, the trade-offs, if you were starting completely from scratch today, building that lifelong portfolio, which one of these would you choose? And of course, a final reminder. This has been an educational breakdown of one investor's framework. This is not personal financial advice. You should always do your own research and make the decision that's absolutely right for you. Thanks for tuning in.